Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday.
Hello and welcome to this week's episode of the Prime Property Finance Podcast. My name is Mark, and in today's episode I want to talk about company structures, and specifically company structures where it comes to title splitting. Now, if you have listened to any of our podcasts to date, you'll know that we do quite a bit of title splitting with clients. It is quite a specialist activity. There's pros and cons to it. And, we talk at length around what those pros and cons are, and I'll touch upon some of those as part of this episode. But as I said, what I'm specifically looking to concentrate on is the structures that you use in the companies, or the ownership structures, I should say, in regards to how you can maximize, or what the consequences of setting it up incorrectly could be. So, without further ado, let's dive straight into it. So, I think the first thing we need to do is just touch upon briefly what is actually title splitting. So, if you are buying a property that has multiple units, normally referred to as a multi-unit freehold block. So, for example, a block of flats, or you may have a shop with a couple of flats above it. There's more than one unit that makes up the whole building, then there may be advantages to actually splitting those titles into individual properties and securing individual mortgages on them. So it doesn't work on every property. You need to do your due diligence as to whether this is a viable strategy for the property that you're looking at. We tend to find that converted houses, townhouses, unless they're particularly large, Victorian, London, etc., don't really work that well with the splitting of title. What works better is purpose-built blocks. Some shops with uppers can also work better. Just bear in mind where you have the commercial element on the ground floor. Often the commercial element has quite a low value, and that could cause you an issue in terms of mortgages going forward. Okay, so in terms of title splitting, that's what we tend to see. We see a lot of these, as I say, coming through to us with our clients. I'm working on one at the moment, which is 14 flats that we're splitting into separate mortgages. And, there are a number of benefits as to what that is. So the primary reason that people tend to do this is because the value of the property as a block usually has a discount on it. And the reason for that is because there is a smaller market of buyers who wish to buy a block of flats. Okay, that's reserved for investment opportunities, investors such as yourselves. And as such, you are going to be buying under a different set of criteria than if you were buying your home. So you'll need the numbers to work. There'll be all sorts of aspects going on. What's the state of the property, etc., etc. Okay, so if you're buying that as a block, it's often the aggregate value, which is the value of each of the units. Then they apply basically a block discount to represent the reduced market that it's available to. Splitting those units then opens the market back up again to standard homeowners, and their buying criteria is often very, very different. It's usually an emotional purchase, and it's usually driven by what they can afford, not what the property value is, what the investment's going to do, etc. So it broadens that up, and then that gets reflected in the price. So the reason that we're working on this one now with 14 flats, it was bought for 900,000. Once we split all the units into the 14 units and we do the mortgages, etc., the value of that is 1.3 million. So you can see there's a significant uplift in its value, and not that much work has been done. It's more of a paper exercise. There has been a bit of refurb going on, but it's primarily a paper breaking down exercise that's created the uplift in value. So that's what we would call an asset management play. On that front, some of the negatives are if you buy it as one block, then you have one lender. You can, as I mentioned, around the commercial, if you split out commercial on the ground floor, very often that commercial has low value. If you know anything about commercial mortgages, then there is usually a minimum loan amount, and that minimum loan amount is sort of 150,000 plus. So by proxy, that means the property value needs to be 200,000 and above if you want a 75% loan to value mortgage. There are lenders that will do less than that, but it's more of a limited pool, and then you have to pay a premium and so on and so forth. So that is one of the negatives. The other one is dealing with multiple lenders. Putting together this deal with 14 flats has not been straightforward. We've had to use multiple lenders. They all want different requirements, different underwriting requirements. One has gone through fairly smoothly, the other one not so much, because they were concentrating heavily on the source of wealth. When you consider this purchase happened nearly 9 months ago. So we've had to go all the way back to how the money came to be in the first place and so on and so forth. So different mortgages running at different paces, all actually need to complete on the same day. So logistically, it's a challenge. And then you're dealing with multiple lenders, as I say, on that front. And especially with the rates changing as well, obviously each lender behaves differently as the rates change. So that's something we have to navigate as well at the same time. But as I say, this isn't really about the title split strategy per se. This is more about the company structures and the consequence of getting it wrong. So where we deal with title splits, there are a couple of things that we need to understand. So you can buy the property and split the titles on purchase, or you can buy the property as a block and then subsequently split the titles. Okay. Now, those are two different scenarios, quite different. We treat them quite differently in mortgage terms. Okay. So if you are buying the property and splitting the titles on purchase, okay, we would just do, for example, that would be treated as if you want to refinance that. So let's assume you use bridging finance to buy it. You split the titles on purchase, and now you want to refinance the property. Okay, we would use remortgages on that basis. Okay, because the titles are already split. Okay, in an event where you buy it and you do not split the title on purchase, and you want to split it at a later date, you have to grant new leaseholds. So split all of the properties into their own titles, grant leaseholds to another entity, and therefore they are treated as purchases as a general rule of thumb. Okay. Now, where does the company structure come into this, you may ask? So when you split titles, you then end up with a freehold and a leasehold property, okay? Now, the freeholder and the leaseholder cannot be the same person or the same entity, okay? So usually what happens is you'll buy the property, a block, into a company. You'll then decide, right, I want to split the titles on refinance. What that means is then you have to sell the leaseholds to the other entity. So it purchases it, hence the purchase mortgage, and it will buy it and you'll get a purchase mortgage on it. Now, if they are two separate entities, and when I mean separate, they have no relationship with one another, that transaction could trigger stamp duty, okay, which negates all of the benefit that you experience in regards to the uplift, because you'll probably end up paying the uplift in tax. Now, if the separate entity is part of a group structure, so usually where we look at it is the freehold. So you'll have Topco, which will be the company that bought it. And then you'll have a subsidiary company, which the Topco will own 100%. You'll sell the leasehold down to the subsidiary company. And because it is in a group structure, it is exempt of stamp duty. Okay, that means that it's still a purchase because it's buying it from the top co down to the bottom co. You still do your normal mortgage as a purchase mortgage. However, stamp duty is not a consideration at that point. Okay, it's an exempt transaction. So as you can see very clearly, the same thing has happened, but the group structure, one will trigger a tax event, the other one won't. So making sure that you structure that is the right way to do it. Now, let's assume you have already done all the split titles in the property. You can do it a different way. So rather than moving it into a separate company leasehold, let's assume you've done it as two structures. You already grant the leases and so on and so forth. Now, the other thing that you could do, you could leave the leaseholds in the property that's just bought it, do a remortgage on those, and you can move the freehold out. Now, why do we move the freehold out into a separate entity? The reason for that is invariably the freehold is worth less than each of the leasehold properties. So if there is a stamp duty trigger, then it's going to be significantly less than if it was you were doing it against the leasehold property. So that's something to consider as well. Now, there may be reasons why you don't have related companies and you want to do this transaction across that. This is a very individual and a tax planning conversation that you need to have with your accountant. We just need to understand what it is that we're dealing with, and we can structure the deal accordingly. But as you can see, that slight variance in company structure could cost you tens of thousands of pounds just through possibly a lack of understanding or not getting the appropriate advice when you're actually going to buy this and split the titles and so on. As I say, that can, in some instances, completely negate the benefit of splitting the title, and then you end up giving it a freehold block because the structure was wrong to begin with. Okay, so that's something I wanted to cover off today. It's something that we came across this week. I thought it was an interesting point that I wanted to share on today's podcast. So the importance of group structures when splitting titles is paramount if you want to get the maximum benefit out of what it is you're trying to achieve. So please go and get some proper tax advice when you're having these conversations. Come and speak to us before you do the transaction, because we can help guide you through that exercise and understand the consequences of either or. We are not tax specialists. We won't give you the tax advice. We'll just tell you what will happen in a specific event. And we will often work alongside accountants to make sure that the advice that you're given works with the structure that we work in, and so on and so forth. So hope you found that useful. Hopefully it will save some of you a considerable amount of money. But as I say, just double check what you're doing when it comes to title splitting. It's banded as this wonderful strategy, and in certain circumstances, as I explained in my example, it is a fantastic strategy, but it's only fantastic, as always, when it's done properly. And the lack of understanding of doing these things sometimes can cost you significantly more than you tend to gain. Okay, so there we go. That's today's episode. I hope you found that useful, and thank you very much for listening. I will see you in the next episode. Cheers, guys. Take care.
Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.